What if I told you that almost everything that you've been told about the rent versus buy decision could be 100% wrong? That the choice you're about to make, potentially worth hundreds of thousands of dollars, might be based on flawed logic? I'm willing to bet that you have taken the potential monthly mortgage payment versus the potential rent payment, compared the two, and that's how you're making your decision. There's a more accurate and more thorough way to evaluate this. Hi, I'm Darin Hunter, and today we're going to dissect one of the most misunderstood financial decisions you'll ever make. Welcome to my channel, where we look to help those interested in real estate make educated decisions. Whether you're a first-time home buyer or you're an experienced investor, you'll find that the topics we cover here are beneficial to all. Learn more by subscribing and following along. The inspiration for this particular video is one that was done by a gentleman by the name of Ben Felix, who did a video on this particular topic in 2019. I don't know this gentleman. He seems to be a pretty smart man. All the signs are there. He checks all the boxes. He's gotten millions and millions of views on this particular video. But when he did this video, interest rates were at 3%. Well, clearly, interest rates are much higher than that. In fact, we're hovering somewhere around 7% today. I felt like there was a need to update the video and give you some more accurate information so you can make this decision on your own. The common perception is pretty simple. If your mortgage payment is less than or equal to your rent, buying may seem like a no-brainer. But this comparison is likely comparing apples to oranges. To truly understand the rent versus buy dilemma, we must compare the total unrecoverable costs of both options. The analysis I'm going to go over there's no doubt about it. It's oversimplified, but it gives you a much better tool to compare renting versus buying, because it does take into consideration all that truly goes into buying a home. Unrecoverable costs are expenses that offer no return or residual value. For renters, it's the rent and maybe a couple $100 for renter's insurance, but that's it. It's simple. For homeowners, it's not the mortgage payment you might think, but rather a mix of property taxes, maintenance costs, and the cost of capital. And the cost of capital, that last one, that's the one that's important. We're going to break this one down for you. All right, let's take a deeper dive. Property taxes are generally around 1% of your home's value. Of course, if you really want to do a much more accurate comparison on a specific home, county, or state, you can determine this by going to the county commissioner's website or by researching the average property tax for the state you're buying in. Most counties do a pretty good job helping you figure out what that millage rate is and put a formula right there on their website. This will help you drill down and make a much more accurate decision. What about maintenance? There's not an exact figure, and depending upon the age of the home, it may require more or less. Buying a new construction, one would think that there would be very little maintenance costs compared to buying a 30-year-old home that may need a new roof, new water heater, new paint, etc. You'll find that the most experts advise that you put anywhere from 1% to 2% away for maintenance costs. So for the sake of this discussion, for the sake of this example, we're going to use 1% on average. We're going to start by using a $400,000 purchase price for our example. So we had 1% for taxes, we had 1% for maintenance. That's giving us a total of $8,000 in unrecoverable costs so far. The cost of capital is split into two: the cost of debt, which is your mortgage interest, and the cost of equity, which is the opportunity cost of not investing your down payment. The cost of debt is a fairly simple calculation. We take the loan balance and multiply it by the interest rate. Today, as I mentioned before, mortgage interest rates are hovering around 7%. Using an example of buying a $400,000 home and putting 20% down, you're financing $320,000. $320,000 times 7% equals $22,400 in interest per year. The cost of equity is a little lesser known way of thinking. We need to determine what our opportunity cost is. Opportunity cost is the loss of potential gain from other alternatives when another option is chosen. So investing that $80,000 in real estate versus some other asset class, for example. In most cases, we tend to think of investing in the stock market, so we'll use that in this particular example. The S&P gets a historical average return of around 7%. So instead of buying a $400,000 home and putting 20% down, you could have taken that $80,000 and invested it in the equity market and expected a return of 7% or $5,600 for the year. Historically, on a national level, real estate has given a return of 2%, while stocks have gained 7%. The difference of 5% highlights the opportunity cost of choosing real estate over a potentially higher yielding investment. So to put a dollar figure on opportunity cost of the $80,000, we would take the $80,000, multiply it times 5%, we get $4,000. $4,000 represents the cost of equity on this particular transaction in this example. To bring the cost of capital all together, we would add the cost of debt, which again was $22,400, and the cost of equity, which was $4,000, totaling $26,400. We now have all the pieces to come up with a fair comparison between rent and owning. We know our taxes are 1% or $4,000, our maintenance is 1% or $4,000, and the cost of capital is $26,400, totaling $34,400. We divide this by the purchase price and we have 8.6% is our ratio on our buy rent rule. All right, now that we have an accurate number, we can use that 8.6 we got for our buy rent rule to quickly gauge the financial sensibility of renting versus buying. Simply take the value of the home, multiply it by 8.6, and then divide by 12 to get a monthly cost comparison. For a $400,000 home, the 8.6% buy rent rule estimates a total payment of $2,866 per month in unrecoverable costs. If you can rent for less, renting may be the smarter choice for you. Now, you can reverse this and figure out what you may be able to purchase if you're getting ready to rent. For example, if you're getting ready to pull the trigger on a rental that costs you $3,500 a month, we can use that same buy rent rule to calculate an equivalent purchase price. $3,500, multiply that times 12, that gives us $42,000. We would use the 8.6 we came up with and divide 42,000 by 8.6, which brings us to a purchase price of around $488,000. Again, this will give you a fairly good idea of what you could buy for the amount you'll be willing to pay in rent. Now, what you get approved for may be slightly different. That's why it's important to speak with a professional. My team and I are happy to help you figure that out. But remember, this rule isn't a one-size-fits-all. Factors like tax rates, investment returns, personal financial situations can tweak this rule, making homeownership more appealing under certain conditions. Now, as I mentioned earlier, this is an oversimplified example of how to compare renting versus buying and buying versus renting. You know, one of the things that we need to take into consideration that is going to change, I mentioned it briefly, is your return on your investment when it comes to your particular area. We all know that real estate is very, very regional. So your appreciation may be significantly higher than 2% and may be lower than 2%. But the fact is, now that you know how to calculate an accurate comparison so you can make an educated decision, you can take the regional appreciation, historic or forecasted appreciation to come up with a more accurate number. Additionally, one of the things that's not really mentioned in this when it comes to when we're talking about the benefits of buying is the forced savings. Look, you know, this particular scenario assumes that you're going to take that 20% and you're going to invest that and you're going to get that 7% return or somewhere around there. Listen, I say this on a regular basis. Unfortunately, you know, we as Americans don't do a heck of a good job on saving when we need to, putting that money away. Certainly, there's plenty of people out there that do a great job, but the mass majority, in my opinion, and the people that I speak with on a pretty regular basis, do not do as good of a job as they should saving. So you're assuming that that money that would have been invested, that opportunity cost that we calculated in our cost of capital, is going to be actually invested. And in my experience, it is not. And that's where owning a home, it's a forced savings account. It's really putting you in a position to save money by building equity. And then, of course, we all know right now, timing is everything. You know, if you buy a house today and you see depreciation, you're going to be cursing me up and down that I told you to buy a house. No, I'm not telling you to buy a house. You need to buy when it's right for you. Simple as that. And here's the thing, if you're buying it as a home, as a primary residence, does it make sense for you and your family? Is this a place that you're going to be able to raise your family? Is this a place where you're going to be able to take home your wife or your husband and live comfortably and be able to make that payment, without any sort of financial distress? If that's the case, then it really shouldn't matter. And if you're going to hold this home longer term than just a 2 or 3 year period, again, a lot of these numbers aren't going to matter in the long run. If you're going to hold it long term, you're going to see a big benefit. The fact is, real estate is not a get rich quick scheme. It's something that you need to take in, you need to buy, you need to hold, and it takes time for it to build that equity. If you're looking for a quick turn, you need to invest in stock market. Take that money that you would have bought real estate and invest in the stock market. Find somebody that can give you the accurate information for you to invest. If you're looking for that, this isn't the right channel. So in conclusion, the buy rent rule isn't just a guideline. It's a tool for making informed decisions in a complex financial landscape. Whether you're leaning towards renting or buying, understanding your unrecoverable costs is key, is crucial. This is how you're going to make an educated decision. I hope this video shed some light on your rent versus buy decision. If you found it helpful, do me a favor, share it with somebody that could benefit from the insights. Don't forget to subscribe for some more guaranteed advice. My name's Darin Hunter. That's another guaranteed video. Have a great day.